Hey everyone, this is Mark Treichel with another episode of With Flying Colors. NCUA released its quarterly credit union data summary report for quarter number 2 of 2025, and the FDIC issued a couple reports, their overall banking profile report and a community banking report. And I'm here with Steve Farrar, Todd Miller, and Dennis Bauer of my team to discuss whatever might have caught our eye when we read through these reports. Gentlemen, how you doing today?
Good.
Glad to hear it. Glad to hear it. Hey, a quick introduction for each of you. Let's start with Dennis this time.
All right. Yeah, thanks, Mark. I've known Mark for about 39 years. We both started out with the NCUA back in 1986. So that's where I started my career. I worked in the credit union world for about 30, or had worked for about 38 years. So 6 of those years were spent with the NCUA from 1986 to 1991. So I started out obviously as a field examiner and also was a problem case officer. So in 1991, I transitioned over to a credit union in St. Paul, Minnesota, and I worked there for 32 years at Ideal Credit Union. Ultimately, I retired this past last September, so almost a year ago, as the chief financial officer and executive vice president. Obviously, my main focus at the credit union was my CFO role, but I oversaw other operational areas such as enterprise risk management, payments, human resources, and IT. Maybe a little bit unique for the credit union. We were consistently a high loan to asset credit union. So a lot of my time as a CFO was spent, obviously, interest rate risk management was big, obviously, but liquidity management, where we tried to encompass disciplined pricing for loans and deposits, obviously pledging collateral for wholesale funding, worked a lot in non-member deposit, loan sales, and participations, particularly the last 10 years or so I was at the credit union. So I've got a lot of experience in that. So over that period of time at credit union from 1992 to last year, we grew from 100 million in assets when I started to just over $1 billion when I retired. So that was our organic growth. And this past year, I joined Mark's team, and I enjoy staying engaged with everything that's going on in the credit union world.
Dennis, as you're walking through that, it reminded me of that used to be a postal credit union, right?
Yeah, it was. Yeah.
I remember you and I being on an exam team there with Leon Handrick, and Leon was training you, and he made you bring in this really big computer printout into the boardroom, and he had you cheering. He told you were going to have to present it. And then he didn't make you do it. So he was just making you carry that around because he could.
Yeah, it was at a steakhouse in St. Paul, Minnesota, and that's where I had my retirement party.
Oh my God!
Yeah, great memories from my NCUA days.
The circle's complete. That's funny. That's awesome. Yeah. All right, Todd, you're up next.
I spent 34 years with NCUA. I started in 1987, retired in 2021. Over that 3 decades, it breaks down to roughly 3 pieces of my career. That first third was spent as a problem case officer and examiner. The middle third, I was a regional capital market specialist. And the final third, I was a director of special actions in the Western region, dealing with troubled credit unions, supervising problem case officers, and regional capital market specialist, and for a period of time, even the regional lending specialist. Enjoyed my 34 years with NCUA, learned a lot, was involved in a lot of conservatorships, returned a few to the members. Those are kind of highlights of the career. Unfortunately, over that time, we've seen a lot of credit unions go by the wayside, and unfortunately, I had to close more than a few of them myself. But all in all, it was a very enjoyable career. Had a lot of diversity in the career, spent a lot of time with complex credit unions, spent some time with you for a full year during the corporate crisis at Westcore. I call it my lost year, but all in all, my 34 years with NCUA was a very enjoyable and diverse career. And I retired, and 2 months later, you called me up and said, "Hey, come to dinner with Marie and I." And I told my wife, "There's going to be a job offer with this."
That's right. And here we are. Many clients later, almost closing in on 300 podcasts, guys. Time flies. Mr. Farrar.
I like what Todd says. So our work being gratifying. I did 32 years at NCUA, broken into two parts. The first half was right in the field as predominantly a problem case officer, and like Todd said, we worked really closely with our credit unions then, and I felt like we were really kind of a part of the team that got some turnarounds, and that provided a lot of. The job provided all the satisfaction you need when they would turn around, and you knew when it didn't that we'd given it the best effort. So those were great times, and it took us all over the place. I mean, we were out in American Samoa and Guam, some of the really interesting places that we got to go to. Then when you went to the central office, Mark, I followed you there and worked remotely in the Office of Examination and Insurance and Risk Management for another 15 plus years. And in there, I got to be involved in many projects, wrote a lot of policies. And once you write one regulation and it goes through, they point at you and say, we got more. So that was always interesting work. I enjoyed working with legal counsel on that. I did do training with the examiners on communications, and that was very rewarding. Then, towards the end of the career, I spent the last part of it really working on risk-based capital, but it was really diversified. And then we've been doing the consulting now for quite a while, and that's been great as we continue to sharpen our saw in the industry and work at keeping up with that. And I really have enjoyed the consulting, and that we can take the time to try and work with credit union management like we did when we were resolving problems as a PCO.
Yeah, Steve, I'm glad you highlighted that, because that is those PCO days, the DSA days, when you got in a good rhythm with the credit union where they had challenges, you had to do supervision, but you could really work together to get the credit union back on path. Were exciting times, and that's really kind of what we do now. So I hadn't really kind of, in my own mind, I hadn't looked at it in that light, but it's kind of recapturing those days when we were able to do that from not the NCUA perspective, yet having that NCUA perspective to help the clients, which is kind of fun.
In fact, it's interesting. I'm good friends with the manager of one of the first credit unions that I worked with as a PCO. After all these years, we're good friends.
Is that the one that has a boardroom named after you?
Well, that's the credit union.
Gotta love it. Gotta love it. All right, guys, let's see. We are going to be chatting about the second quarter data. Which topic do we want to talk about first from either one of these reports?
Todd, you can have first choice.
I thought we agreed before this that Steve was going to direct this whole calculation.
I think he just did that. He just people directed. Todd, what do you want to do?
Need a redirect.
Well, I'll start with just something kind of simple. Just looking at growth rates for our banks and credit unions. Credit unions have done really well with their deposit and loan growth, much better than the community banks have, much better than the banking industry overall. Pretty much since December of 2023. Back in 2023, bank deposits were growing a little bit faster than credit unions. But ever since then, credit union deposits have grown significantly faster than those in the banking industry. So far through the first 6 months of 2025, credit union deposits grew 6.4%. Banks only grew 2%. And you're seeing a similar thing with loan growth. Credit union, both banks and credit unions' loan growth was not very robust in 2024. It was actually small numbers. But here in 2025, for the first 6 months, credit union loan growth was at 4.4%. Banks were only at 2.6%. So credit unions are doing much better at that loan growth key. It's kind of interesting where the credit union loan growth is too. It's mostly in commercial loans and home equity lending. There are other lending types that have been pretty much static.
And those can tend to be bigger loans, which could be how the growth numbers, you get a little bit of a niche there that can add to those numbers pretty quick. Steve and Dennis, any thoughts on what Todd had to say? Or that topic?
No, that stood out to me as well, particularly with deposit growth, where credit unions were struggling for so many years, sort of lagging. And this past year, over year. Yeah, as Todd said, over 5% deposit growth, and it's still being fueled, it looks like, mainly by short-term certificate growth. Obviously, there's some money market growth as well as regular share growth. So it's great to see that. And then right as a result, I think you see the borrowing to asset ratio for credit unions decline a little bit because liquidity is probably improving as well. So that was good to see that.
Great point. Steve, anything on that before we move on to another category?
No, I think we've covered it pretty well.
Very good. All right. Net interest margin. Steve, I know this one's near and dear to your heart. So you want to chat a little bit about what your thought is on that?
Well, it's kind of probably always near and dear to all of our hearts here, and that it drives so much, and it's kind of like, well, how is it really going for the credit unions? The net interest margin, did increase. Was it 8 basis points for the quarter? Pretty consistent with what you saw in the community bank area there. They had that their net interest margin increased 16 basis points for the prior quarter. So everybody's seeing that increase and improve, and that was a key driver to try and get income to come up. Kind of what I want to talk about with that one is, and I always talk about what do we think is going to happen next quarter and throughout the rest of the year. I kind of would want to throw that out and see what Todd and Dennis have to say about where we're at with that from the quarter performance and how it looks for the rest of the year.
Yeah. From my perspective, depends on what happens with short-term rates, Fed rates, right? The Fed funds rate. I think if the Fed it's aggressive, which they may because of maybe unemployment issues, and it seems like maybe inflation is tame, they may go pretty aggressive, maybe 50. We've been talking about this next week, maybe probably 25, but maybe another 50 to 75 to 100 before the end of the year. I think if that happens, right, just because of the makeup of balance sheet, a little bit more cash, you might start to see margins maybe narrow a bit. I don't think it would be that significant though. But in the short term, when short-term rates drop, credits generally, the margins would tend to narrow a tad. So that's what my take is on it. When you take a look at the makeup of why the net interest margin, I looked at it on a year-over-year basis rather than on a quarterly basis. For credit unions, they picked up a lot of yield on earning assets. That was up about 25 basis points over the last year, whereas cost of funds declined roughly 5 basis points, which is interesting when you look at all FDIC insured banks. The big banks, I think, struggled on the margin a bit because if you just look at all banks altogether, their margin only improved 7 basis points. But if you strip out the larger banks and just look at the community banks, their margins increased similar to credit unions at around 25 to 28 basis points. And the makeup of how that happened in the community banks, the smaller banks, was sort of split. It wasn't all related to yield on earning assets. It was partly yield. It's probably 50-50. Yield on earning assets increased by about 16 basis points, whereas their cost of funds declined by 12, making up the 28. So that was interesting to see that little bit of a nuance, I guess, in community banks versus credit unions of how the net interest margin improved is what I saw during my review.
That's interesting. That the big ones dragging the average down, and then when you compare the community banks, which are more similar to credit unions, there's a little bit more of a correlation, but still a difference.
Yeah,
I have kind of another take on it. I'm going to go put my old problem case officer hat and my DSA hat on. And when credit unions had earnings challenges, one of the things we always talked about was operating expenses because that's the thing they have the most control over. It's really interesting. If you look at the 6 quarters since December of 2023, the banking industry have reduced their expense levels every quarter, and the credit unions have went up every quarter. And right now, there's about a 40 basis point ROA difference between credit unions and community banks, and it's almost all in that operating expense difference.
Well, that could be a podcast in and of itself. That's interesting.
Yeah. And where that happened, mainly for credit unions, again, I look year over year was up 12 roughly 12 basis points. I think, yeah, non-interest expense was up 12 basis points for credit unions, and for all banks, it was up, let's see here, about 2 basis points. At the community credit or banks, it was up 3 basis points. And right for half of it was related to salary and benefits. That's where the bulk of that increase occurred. So, right, I don't know, partly maybe inflationary pressures on credit unions related to that. Cost of living might have resulted in that, and banks sort of held back a bit on increasing probably salary and benefits.
And hypothetically, maybe bankers are paid a little bit better. It's getting more competitive out there to keep people around. The credit unions are having to pay money to either bring people in or up people to keep them there. That possibly could lead to a little bit of that credit union growth.
How much of it was salary and benefits, Dennis?
Of the 12, I think it was from what I remember, I didn't write that down, but roughly, I think about 6 basis points, about half of that, I believe, came from salary and benefits. When you broke it down into the various categories, that one sort of stood out to me.
I wonder if some of it, we've had a lot of clients that went through data processing conversions. I wonder if some of this is just keeping up with technology, keeping up with data security or information security. I didn't look at the breakdown. It's just an observation that they're going in the opposite directions on the two industries.
In one ratio I always follow is just average. What is the average salary and benefits for credit unions? And if I didn't pull this report, not in front of me, but I believe that average salary and benefits for all credit unions was approaching a little bit over 100 grand.
Right in front of me, $599.
Yeah. So that's up, I think, a bit from a year ago, about 6,000 or 7,000, I believe.
A year ago, it was 102, so it's up almost 4%.
Yeah. So I think that's where the bulk of that expense is occurring.
Fascinating.
Yeah, there is some increase also in just education and promotion, and that's not surprising. And that we talked about competition, and that would be the reaction, because you do see credit union advertising out there in more spaces that you didn't used to see it. So
Stadiums and the like.
here we are.
I did. All right. Any last topic on, we did NIM, we kind of did expenses as it relates to profitability. What's next, Steve?
Let's go on portfolio performance. The trend looked pretty good, I think, on just overall delinquency. And let me look at it again real quick. Delinquency is just up just a touch from where it was a year ago, up a bit from the quarter. Compared to the community banks, the numbers aren't always so comparable. It seems like the credit union delinquency is higher than that, and that's reflected in the loan losses, because the credit union industry does operate pretty significantly higher loan losses than are in the community banks. And that, of course, is another element affecting that overall net income, and that the PLL, the average assets for the credit unions, was like 0.6%, a little less than that, and it hasn't moved much over the last few quarters. But in banking, it's only like 0.2. So that's a pretty significant difference that's occurring between the two businesses out there. So that was my observation on loan quality.
Overall, the delinquency trends in the banks and credit unions are almost going in lockstep, even though the banks measure that delinquency number a little bit different than the credit union industry does, because they throw non-accruals into their delinquency. And they start measuring at 30 days. Credit unions start measuring at 60 days. But the trends are just virtually for the whole portfolio the same. And what you do see in the community banks is their commercial loan delinquency is very low. Credit unions' commercial loan delinquency, and it's one of the fastest growing portfolios, but their delinquency in that commercial loan portfolio is inching up too. In fact, it jumped almost 20 basis points just in the last 6 months. So it's like 105 now for just their commercial delinquency in the credit union industry. And that's a number that I would think would have the folks at NCUA a little bit nervous.
So nervous they're eliminating the risk ratings, but that's a topic for another day.
Just to add a little bit onto that combination of where loan growth is occurring and what's going on with charge-offs and delinquencies, right? Unemployment's still relatively low, which is a good thing. And real estate values obviously are sky high, which right now is a good thing. But if that concentration of continues to grow in real estate and we start to see an increase in unemployment and we start to see housing values drop, then that most likely is going to have an impact on the CECL calculation, which could impact credit is probably more significantly, I think, than net interest margin if we start to see that downturn potentially in the economy. So, right, we're sort of at the high point, if you will, for unemployment's been picking up a bit, but not significantly, and real estate values, right? So we're at a very position with both of those. So most likely those are going to deteriorate a little bit or significantly, depending upon what goes on with the economy. That could impact the provision for loan loss.
Kind of an observation along that lines. I didn't look at NCUA state profiles, but the FDIC's quarterly profiles, they do put regional information in there. And for delinquency, like for community banks, it ranges from 0.4 in San Francisco to 0.68 in Dallas. I mean, there's a 20 basis point difference in delinquency just amongst their different regions. And they have similar differences in ROA. There's a big spread in ROA between the different bank regions. Like I said, I didn't dig into NCUA's regions or their state profiles, but I wonder if maybe some of that still exists within NCUA as well. Maybe we have some regional differences going on within our credit unions.
I would imagine that's the case. Steve, any thoughts on asset quality?
No, I think we've covered it pretty well, and now that reflects back into affecting earnings.
You got it. Well, and earnings and CECL, and I know enough about CECL to not quite be dangerous, but it's definitely not my expertise. It used to just be the allowance, and you'd individually classify and be gone, and we've changed it a few times from there. But there were some sways with credit unions on how that, when they implemented it, and it had some unintended consequences. And then the second year, there were some challenges that it created in some institutions. But as Dennis, if the economy starts to slip, it's almost like a double hammer now in that CECL, because you got the real delinquency and the losses, and then you have some other environmental factors and different things. This isn't a CECL podcast, but I could see that really having a bigger increase or a bigger impact than pre-CECL.
Yeah. And then there's so many different flavors of CECL. They're not consistent at all. I know the one we use is heavily influenced by sort of what's going on with real estate values and what's going on with unemployment. That can, even though it might look like your delinquency is great and your charge-offs, I mean, if that starts those environmental factors change, that's really supposed to influence that calculation. So,
right.
And I don't know if that's probably not being done consistently, obviously, across the board.
Good point.
One thing you see a little bit of economic, struggles amongst individuals. While unsecured lending isn't a huge part of credit unions' loan portfolios, I mean, the charge-off ratios for credit cards, unsecured lending, they've been inching up. And, within the credit union industry, charge-off ratios on credit cards are 5%. That's probably getting up there where bank charge-off ratios are. Other unsecured lending is in the 4% range. So it's a small part of the portfolios, but it's a big chunk of credit union losses. And, I don't know, over my last 5 to 10 years at NCUA, you did see a lot of credit unions leaving the credit card space. And, it's not necessarily growing to any degree, but it's definitely costing credit unions some money and charge-offs. And I think it's just the whole thing, the economy and saving rates and everything. But the unsecured charge-offs are pretty significant.
Yeah, those are big numbers, which I had pulled up a tweet, or do you still call them tweets, even though Twitter changed from Twitter to X? Is it still a tweet? I'm going to have to go to the dictionary to check that out. But Somebody who listens to this podcast who is ex-NCUA sent me a tweet from the Kobayashi letter. I'm not sure if I'm saying that right, but the tweet was this. And, if it's on Twitter or X, it's got to be true, right? So this data has to be as high quality as NCUA's and FDIC's, tongue in cheek. The car market bubble is bursting. Subprime auto loan delinquency rates have now surpassed 5% for the first time in history. The 60-day delinquency rate for subprime auto loans has more than doubled over the last 3 years. Delinquency rates are now roughly 1.5 percentage points above the 2008 financial crisis peak. At the same time, prime auto loan delinquencies rose to their highest level in 15 years. Conclusion, an auto debt crisis is brewing. My first reaction to that was, how is it possible that 5% is the highest that subprime auto loan delinquency has ever been? Any thoughts on what I just rambled on about there?
I suspect it's been much, much higher in different times in the past. For credit unions, though, that just kind of a side observation is their auto loan delinquency has been creeping up just about every quarter. It's up to 1.1 now. Just 2 years ago, it was only 63 basis points. So it's doubled in 2 years.
Okay.
But credit unions in 2024, there was no loan growth in the auto segments at all. So their portfolios are not going anywhere. And I think part of it is, car prices are ridiculous and cars are lasting a little bit longer. I haven't looked at automotive sales in a while, but only those auto loan portfolios, which were credit union bread and butter, have not been growing the last couple of years.
Yeah, I think inflation killed the consumer's ability to service all those high cost auto loans, purchase the auto, if you purchased an auto prior to inflation, right, then all of a sudden you're up 20%. And with inflation, so I remember experiencing the last year I was at the credit union, you saw that the household income drop was impacted significantly. And it's probably still impacting a lot of the consumers out there.
No, makes sense. All right, what next on the list there, Mr. Farr? Liquidity, the big
Liquidity. And that one I do have to throw to the operational experts on our panel, is that is not my area of expertise, but it is always a topic that's, our clients are dealing with quite a bit. So Dennis and Todd.
Yeah, what was good to see is the unrealized losses in the investment portfolio improved significantly year over year. Thought I had this number as a percentage of investments, but it's a percentage of assets is what I found. So that is improved 41 basis points from a year ago for credit unions. I didn't have that for banks. So, right, that helps out. Obviously, liquidity positions significantly. I think too, right, just the balance in growth that we're seeing in loans and deposits, right? We don't have loans outstripping deposit growth, though that's provided some relief. So the cash position for credit unions has remained pretty stable compared to a year ago. As a percentage of assets, it's dropped, but probably assets are growing a little bit faster. So that's from our ratio perspective that counts for the ratio. But I think as far as cash, if I remember reading that, I think that's a significant amount compared to 12 months ago. So from what I see, liquidity positions have improved just in general for credit unions as a whole.
That's in part because now we've had a year and a half share growth outpacing loan growth. So cash on hand is the ratios haven't really changed much, but they've paid down borrowing money. While those unrealized losses have improved, they're still significant. And you can definitely see that the credit union industry thinks interest rates are going to go down, because the piece of investments that grew the most is that 3 to 5 year period. I'm surprised that back in 2000, let's go do it again in 2020.
Must think we're at the high end, but yeah, that was surprised to see that area grow again. Well, the 10-year rate, it was nice to see the 10-year rates down to around 4%. So I would think if that continues, I think the third quarter, which is fast coming to a conclusion, we'll still continue to see better unrealized losses in that portfolio, I would assume.
So they're betting on that 75 basis points to come by going to 3 to 5 years. Well, we're going to find, we'll do this quarterly here on until eternity. We'll cut this and we'll play it and go, that was really smart, or that was really not. Okay, we covered liquidity, we covered earnings, we covered asset quality. Have we talked about capital? Or Steve, where are you taking next on this journey?
That was the last topic I still had on here. It was capital, because that kind of it reflects everything we've talked about previously. The news is good for the industry and banking industry both, is that it improved in the quarter. For credit union, with the past, net worth growth did outpace asset growth. So that was good. And so it did increase. We got 13 basis points, and the banks basically on the same ratio had 10, or the community banks had 10 basis points. So it's nice to see that one growing up. And then the risk-based capital increased also, but we have all those credit unions using the complex credit union leverage ratio. So you expect that number to remain pretty high, and it looks good. With that, it feels like, the capital strength of the industry is doing well. Even behind those capitals, but the insurance funds both had good quarters, especially the FDIC insurance fund, which kind of sits back there, and, that affects their expenses, is that reached the level where they're no longer subject to a resolution plan. So they're increased greatly for them. So that's good news for the entire industry, I would say. So capital with both in the institutions and in the deposit funds improved.
That's a good.
I will say there is one observation, though, that's worth noting, as credit unions largely compete against those community banks, and those community banks have about 130 basis points more in that capital than credit unions do. And that gives them a little bit of competitive advantage, and I don't know if we'll see a point where subordinated debt grows. Back in 2023, it went up about 9%. The last 18 months, it's only been growing at about 1%. Maybe if rates drop here a little bit, we'll see a little bit more issuance of subordinated debt. Certainly, I think there's, low-income credit unions out there that could still take advantage of that to a certain degree, because loans are still growing. Having a little extra capital always improves your strategic options, so to speak.
Always good to have options. I think that's a good observation, that rates coming down will create that opportunity. And thinking out loud, if credit unions are 130 basis points behind, if we
Community bank.
community banks, behind community banks, 130 basis points lower net worth ratio credit unions have. Is it 230 basis points if you discount the NCUSIF? Or did you already do that?
No, I did not discount the NCUISF. So that makes it a little bit bigger difference.
It's even
Now, overall, if you compare them against all banks, credit unions have more capital than all banks. But, that direct competitor, the community banks are more capitalized than the larger banks. And I think a lot of it is they're family-owned banks, too. So,
right. Makes sense. What else on capital, guys?
I think that's it.
Any last thoughts on quarter two?
I just think there's headwinds for the credit unions out there. Like I said, they haven't been able to grow those auto loan portfolios. That growth is in home equity loans and commercial loans. It always makes me nervous when, like, the banking industry is contracting on a product. So, they're shrinking their commercial loans or holding them stable, and that's where they're growing the fastest in credit unions. Now, in the big scheme of things, the credit union's market share in that commercial loan area, it's minuscule. And credit unions have 6-7% of their assets in commercial loans. Those banking industries, that's up in that 30-40. So it's a totally different business model. It always would make me nervous as an examiner supervisor when you see credit unions growing an area that the banking industry is shrinking. It's like, is your timing really good? Or are you getting in this at the exact wrong time? too many times in history, it's like, well, you got in there at the exact wrong time. Beavis Credit Union's market share is small. There probably is a lot of cherry picking going on where they're just picking off some of the absolute best borrowers. But at the same time, that delinquency in those commercial portfolios is inching up. And, that's a tough one because net charge-offs haven't inched up. Delinquency has inched up a little bit. And, how will that play out? Because the resolution time frame, especially for credits, which it's a lot of commercial real estate, you don't fix that very easily when people start getting behind.
Great points. Dennis, Steve, any last thoughts?
Yeah, I always like looking forward is I always try to focus on, and looking at even some of the pronouncements OCC put out, and looking forward is this uncertainty that we continue to deal with the market. And nobody likes dealing with uncertainty, but you do have weakening signs that could affect the consumer loans if inflation picks up or we hit stagflation. All not good for the loan portfolios. Interest rate uncertainty is certainly elevated, and factors affecting that we're not used to dealing with. And then the evolving and complex operating environment is proving to be difficult for some, especially not so large credit unions. So lots of uncertainty out there to deal with.
Great point. Dennis, last thought?
No, it's just in general, though, credit institutions continue to be well capitalized. Hopefully they're managing credit risk and concentration risk so that they can see some of those headwinds coming and have proper risk management in place to minimize any downturn that we may have in the economy. I think in general, most credit unions do that. So there's going to be some outliers. Credit union industries remain strong through various cycles. So I would think that would continue throughout the next few years in front of us here.
A couple of you mentioned headwinds, and that made me think of this. I've been listening to a couple of different fintech podcasts. One, because the guy's just really funny and has been teaching me some things. And they have a podcast on once every other month or something where they talk about fintech companies, and they say it's not investment advice, but they find these companies that are doing unique things. And they were talking about one that was in the payments arena, and the guy basically said, this is really cool, and I'd like if it was on an app, but I don't know how they'll win this market. And he talked it in a concept of, are you just surviving or are you winning? And I thought about it when I heard that. I thought about with mergers and things. And so when I hear headwinds and I think about possible challenges with the economy, might or might not happen, unemployment might or might not happen. It's happening a little bit, but then again, the numbers are squishy. Credit unions that are in this survival mode, and then they just tap out and they end up merging. And what are you doing to make sure you're, going to be here 5, 10, 15 years? I think is probably the biggest challenge that I see financial institutions taking and having to deal with right now.
Yeah, another uncertainty, of course, that's going to affect everybody is that turnover that occurred with all of the banking regulators in terms of a lot of senior staff has departed. Staffing levels are lower, so it's hard to say exactly what the impact of that will be. You'd like to see some gains in efficiency and examinations, not taking quite so many resources from credit unions. But experienced examiners, I think, are one of your best resources, and a lot of those aren't there anymore.
Yep, great point. All right, guys. Well, when we're recording this, what is it, Wednesday? This episode will go out Thursday. 2 days ago, the J.J. McCarthy era for the Minnesota Vikings started.
After a shaky start.
What's
He's off to a shaky start.
I don't know. He's the first time starter to ever have 3 touchdowns in the fourth quarter. I think you're wrong, Dennis. Your Pittsburgh guys have a 42-year-old quarterback. My JJ is only 22, and the Micah Parsons era has started in Green Bay.
We'll see.
We'll see. I'll in 2 years, Dennis, when we check if the commercial loan increases were good, we'll see where Aaron Rodgers is and where JJ McCarthy is. And as JJ said, where else would you rather be?
Yeah.
As a Packer fan, I thought watching the Chicago Minnesota game in the third quarter, thinking, yes, Minnesota's going to start the season with a loss. And then the next day, it's like, well, dang, that didn't turn out the way I thought.
That didn't quite turn out. He's a
Yeah, they have these on the NFL. They have these probability charts, and I think in the third quarter, Chicago had like a 95% chance of winning the game, and there was a little questionable call, I thought, on link.
Yeah.
But the Steelers have the bars, man. They kick field goals all year long.
That's right. Yep. Yep. Well, we will see. And Steve, who are you rooting for this year?
The referees.
The referees. Yeah, let's hope they get it right this year. All right, guys. As always, listeners, thank you for listening.